Right. Good morning, all of you. On behalf of SC Securities and Daily FT, let me warmly welcome all our viewers and our distinguished panel of panelists. We have with us today Mr. Chanakya Disanayaka, Senior Director and Global Head of Investment Research at Equity Knowledge Partners, which is formerly known as Moody's Analytics Knowledge Services. Mr. Hasta Premaratna, Group Finance Director at Brandix, and Mr. Ruchir Desai, Fund Manager at Asia Frontier Capital Limited. The event will be moderated by Mr. Nesta Kasim, Editor-in-Chief at Daily FT. So, the theme for today is attractiveness and opportunities in the Colombo Stock Exchange, right? So at the outset itself, let me share with you some interesting statistics that reflects how attractive the market is. Right, if you look at the first slide, we have looked at the stock exchange performance over the last 10 years in terms of the all-share price index as well as the market price earnings ratio. If you look at the all-share price index, both the all-share price index and the market price earnings ratio is at a 10-year low. Compared to the all-time high of 7,800, the market have come down by roughly 38%. And compared to historic highs of the price earnings ratio, it is currently trading at a very low ratio of 9 times compared to highs like 19.7, 18 times. So this reflects how cheap the Colombo Stock Exchange is. If you move to the next slide, we have looked at the regional markets and we have compared them in terms of the market price earnings ratio. And you see that all share price index is the cheapest in terms of the price earnings ratio of 9.39 compared to some of the other Asian markets such as India, which is trading at 21.5 times, and Nikkei 225, which is trading at 25.18. So in that angle also, the all share price index is very much cheap. In the next slide, we have looked at the year-to-date decline in many of the markets. By how much did they decline to the lowest point? So for example, CSE declined 31%, MSCI frontier markets 35%, likewise. Then from that lowest point reported in year-to-date, how much have they retraced or how much have they bounced back? So you see that most of the markets have declined in the range of 22, 30, 37% maximum, whereas the Sri Lankan market have retraced only by 14%. One of the main reasons why Sri Lanka is lagging behind is Sri Lanka joined the global rally with roughly about 7 weeks time lag because the market was closed down until the lockdown was over. So there's a tremendous potential for the Sri Lankan market to fill this gap and be in par with other markets in terms of the levels they have retraced, because Sri Lanka is one of the least affected markets in terms of COVID-19. In the next slide, this reflects the decline from the all-time high. All the markets are below their all-time high levels, and Sri Lanka is among the few markets which are down by roughly about 40%, right? If you look at Sensex, it's just 23% below its all-time high, FTSE just 20%, but Sri Lanka is among the few which have declined closer to 40%. So this also reflects that we are a cheaper market compared to the region. In the next slide, now how oversold is the stocks at CSE? To put things into context, we looked at two market valuation indices. We looked at how many companies are trading below their net assets value. So if you see that is price to book value less than 1, 71% of the companies in CSE are currently trading at a price to book value less than 1, 71%. And roughly 35% of the companies are trading at a PE less than 8 times, and another 18% is even below 5 times PE. If you look at certain fundamentally strong shares, most of them are trading at valuations which are cheaper than what we saw during the height of the war. During the height of the war in 2019, stocks have even become cheaper than that. So this leaves a lot of potential for stock market, the Colombo stock market, to rebound. Now, if we go to the other slide, looking at the post-COVID-19 market performance, we did a small analysis. We looked at the 52-week high prices of a pool of shares. Now, these shares are very highly liquid, heavily traded stocks, what we have selected. We looked at the 52-week high price, and from that point, by how much did they come down when the market recommenced trading? For example, if you look at Ceylon Bank, from the 52-week high price, Ceylon Bank share price came to the lowest intraday price reported when the market recommenced trading was 83% below. If I give you some numbers, Ceylon Bank 52-week high price was 67 rupees and 56 cents adjusted for the rights issue. It reached an intraday low of 25 rupees, so which is a decline of 63%. From that intraday low price, the share rebounds back to 45 rupees and 80 cents, giving a total return of 83%. Right. So similarly, if you look at ACL, ACL came down to an intraday low of ACL came down to an intraday low of 22, and from there the share price have retraced or bounced back 81%, right? And one thing that you could notice is most of these shares have come down more than the overall market. When the market came down 32% from the 52-week high, when the market recommenced trading, all these shares overreacted compared to the market. So in the recovery phase, these shares have recovered at a higher rate than the overall market, giving a tremendous return to investors. To name a few, if you look at John Keel's declined 53%, and that have retraced by 47%. So it's interesting to see from this point, from the current level, how far is it below the 52-week price, high price. If you move on to the next slide. Now, all share is still about 22% below its 52-week high level. Tokyo is still 47% below its 52-week high. Likewise, most of these shares that we have selected, the highly liquid ones, they are trading at a 35% to 40% discount to their 52-week high prices. So these are good examples, or these demonstrates the context or the potential of the opportunities that are available in the stock exchange, and what sort of a return that you can generate by making timely investment in the stock exchange. So if you go to the next slide, yeah. So that's some of the interesting statistics that I wanted to share. So let me now invite our distinguished panel of speakers to make their initial remarks. So Nista, over to you.
Thank you very much, Charita. Thank you very much. Welcome everyone to all our web participants. I'm sure more will join as we progress. I'm privileged to have this excellent panel of who will bring insights to us in terms of investing in the stock market. I think Charita made an excellent presentation of bringing the the dynamics of the market, recent dynamics, I would say. So what we'll do is we'll get some opening remarks, and then we will go for some questions. I like to invite everyone in the web audience as well to share their own questions, and we'll see how we will accommodate some of them as we progress. I'd like to invite Ruchir Desai to sort of give a foreign investor perspective in terms of the attractiveness of the Colombo Stock Exchange.
Great. Thank you, Nishsar, and good morning, everybody, and thank you for having me on the panel. Good to be here. Look, from the foreign investor perspective, I think over the past few years, especially as Charita pointed out, the market has been cheap. So it has been an attractive market from valuation perspective over the past few years. In the last couple of years, of course, you had political instability and political uncertainty, which led to some of these low valuations, some uncertainty over there. And also in the recent past, I would say when the pandemic hit, the market was shut for a couple of months, which sort of sent a negative signal to some foreign investors, but not all. These sort of things are out of everyone's control. So I think hopefully the regulator learns from these experiences and prepares to factor in some of these conditions if they ever happen again. It could be pandemic, could be anything else which could affect overall market operations. So that was a bit of a downside or negative aspect of the pandemic for Sri Lanka. But other than that, valuations are very attractive. Now, if you take a longer term view, of course, the pandemic is an issue which is going to affect all the markets, not just Sri Lanka. So, coming out of it will take a couple of quarters, maybe a year or so for most markets. But beyond that, if you take a longer term view, I think Sri Lanka's valuation is very attractive. Their geographic position is very attractive in terms of where they're located geographically. And also geopolitically, I think they're gaining more significance because of the competition between China, India, and the US. So I think that will gain more. I think Sri Lanka can gain a lot of influence and also investments because of that. So overall, I think the prospects look good. I think once we pass through these near-term uncertainties over the pandemic and the politics, I think we can take a more positive view on Sri Lanka. That's what I have to add from an opening comment perspective.
Mr. You're on mute.
Sorry. Hasita, I'll invite you now to make your own opening remarks.
Yeah, good morning. Thanks for inviting me to share some thoughts around the market and in the broader economy, as well as a little bit I'll touch on how the industry side works right now. So I think to begin with, we were coming out of many things in the last 12 months. If you look at the April 21st attacks and the resultant impact on the market and how we were gradually building things up. And then there were many other things, the political climate with the elections, no elections, and then gradually post-election, there was a high expectation of the market to pick up, and then the general election was announced, but not yet the dates have been confirmed. So there are multiple political related issues also that adds up to this in the lead up to the COVID-19 issue that hits us. And thirdly, obviously, with the fiscal deficit and the BOP side, we had balance of payment side. Again, we had challenges with the debt repayments being quite high and certain tax policy changes reducing the income levels, at least in the short term. And these were all known by everybody, so there wasn't anything that had to do with COVID. Even it comes to these three factors which I highlighted, when we touched and when we moved in suddenly in mid-March, when the real impact hit and the markets basically started to react to it, there were few changes to the fundamentals that took place for sure, right? When I say few, they can be few in number, but in terms of the depth of the magnitude of the impact on the fundamentals can be severe. So that's something that we should not underestimate or take it light. But having said that, I think it's important to distinguish between the pre-COVID scenario and what the COVID impact brought in, and then look at the fundamentals of the market and see what has changed and what has not changed and how it need to kind of be looked at. So accordingly, if you look at the impact on COVID side, mainly the way I see it is that the businesses came to a standstill. So all the exports and related industries had an immediate impact because it was somewhat resilient in the past compared to the local industry whenever there were local challenges, because you at least managed to export to the global markets. But here the whole world was impacted. So that's one of the key issues that we saw in this particular situation, where some of the exporters were more impacted even compared to the local businesses because of it being a significant global pandemic. But then having said that, the impacts of that are likely to trickle down into almost all industries that we are talking about, and that did give investors a lot of negative sentiment at the beginning, and that led to the sudden crash in the market. Like Charita said, I think we had almost 32% drop. But having said that, if you look at that intraday numbers, unfortunately I was too busy with my work. Otherwise I would have loved to jump in for that to catch up those intraday prices, which were never available other than for, I believe, a few hours or few minutes. But I think reality is that everything has a value, right? Everything has a value. So COVID did have an impact on the fundamentals, but did it really have an impact on the longer term fundamentals? Something that probably we can discuss as the session progresses. But more importantly, when the prices were attractive, I thought that it was quite interesting to see how people were coming into the market and picking up stocks. So in twofold, one was the foreign angle and the local angle. The foreign angle, I think foreigners were very active in the last 3 years in the market, representing almost 40 to 50% of the market turnover. And they have been taking positions more with a longer term view, looking at the longer term fundamentals. But some selling was there, obviously, because of the margin calls, etc. But other than that, I think with the valuations getting attractive, chances are that there will be more opportunity to average down and pick up those stocks if the view on the longer term fundamentals is better. The 12 months will be very different. We'll look at the 12 months differently. And the local front, we saw a lot of people coming in with a view of strategic stakes, and especially the position opportunities, etc., and the controlling side. And with that sentiment, the minority investors also are likely to benefit. So I think the local side also jumped in immediately with that view. But overall, whether the reaction that we have seen so far in the last 3 weeks with the market reopening on May 11th, the behavior of the foreign and the local investors in the situation is more circumstance driven and more reactive, in my opinion, than looking at a more of a longer term view. So probably to close the opening remarks, and maybe we can talk about a little later, the question really we need to ask here is that the fundamentals of the market how far has it changed from pre-COVID, and the prices that have fallen since March, has that reflected that fundamental change or over reflected it, like Charita showed? And maybe that's where certain opportunities will come for bargain hunting, particularly in those fundamentally sound stocks, which ultimately in the 2 to 3 year horizon, how it will change. So my argument is in the market that we should really take a beyond a 2-year view, and or one to 1.5 year, beyond a 1 to 1.5 year view, say 12 to 18 months, we need to kind of say that, okay, I'll put this money here, low interest rate scenario, let me pick some stocks and hold it for beyond 12 to 18 months, because that's the real phase, in my opinion, that will be impacted due to COVID, and there will be significant implications that will come in the next few months also to the economic side, no doubt about it. So we will have to keep looking at that angle in the next few months, and look at how we can pick up. In the meantime, if there are trading opportunities come, that's great, right? But that's not something that people should overly bank on and try to chip in with a trading angle, but instead more looking at picking up longer term fundamentally sound stocks with a 12 to 18 month view. So this I'll stop there, and then maybe we can talk about more in some of those specifics later.
Yeah, thanks, Hasita. Move on to Chanakya to give his opening remarks.
Yeah, hi Nista, and good morning everyone. So in my opinion, Sri Lanka does face very well known short to medium term economic risks. They are very well known. There is no need to deny about it. Everyone agrees about them in the investment markets, both local and overseas. But what we have also need to appreciate is that during the past 5 to 6 years, Sri Lanka's equity valuations have been progressively coming down continuously, and it was basically further hit by 2 events, last year's April 21st attacks, and it also reacted just like all other equity markets and debt markets in the world for the COVID-19 correction. So for me, the May 11th bottoming out is some sort of like a watershed moment, because you saw the blue chips, liquid blue chips that typically the institutional investors like to hold, the sell top 20 index like blue chips, drop into a valuation around 5.5 times trailing price to earnings. You saw systematically important licensed commercial banks that are very well profitable, very well capitalized, drop into valuations like 30 to 40% of their book value. Some could say that these are essentially liquidation valuations. So at that moment, I think certain things started happening, and the large domestic investors and large local institutional investors who are very familiar with the Sri Lanka's capital market history, who at the end of the day takes a view that unless you subscribe to a doomsday view on Sri Lanka, are you going to see valuations dropping even more? I think that really happened. They started asking questions. Yes, there are many risks. There were certain unknown risks related to COVID, but at these valuations, in certain cases for some of these blue chips, these valuations were not even seen during the peak of the war. And Sri Lanka fought a war, went into a global financial crisis in 2008. Some of these valuations were not that low during that period also. The domestic large investors also are cognizant of the fact that if you look at Sri Lanka's long equity market history from about 1993, most of the equity market return was actually driven by three events or three bull runs. The 93-94 opening up to the institutional investors and the emerging market investors coming into Sri Lanka. 2002-2003 peace process driven bull market, and of course the 2009 massive bull market created by the 3.5 decade long war coming to an end. So with the valuations dropping to these lows, they started asking the questions, are we going to see valuations dropping further unless you subscribe to a doomsday view? I think by now, we know COVID is going to have a major economic impact globally. Those projections are out. Sri Lanka is also going to see quite a bit of an impact. But at the end of the day, for long-term institutional investors, they also took a view whether, at the end of the day, whether valuations and prices for some of these largest companies in Sri Lanka and the banks, have they accounted all those risks? And that's what I think we saw happening. And one could say that, especially since I mentioned the banks and banks dropping to 30 to 40% of the price to book values, one can say that, last couple of years, banks did trade at a discount to their book values. Yes, it did. Sri Lanka also underwent a low economic growth scenario. Also, you shouldn't forget that all the large banks were heavily building up their capital base as the Basel III implementation progressed. So you saw quite a bit of a capital build-up, capital cushion build-up, and the returns coming down because of that, and some of the valuations also getting affected because that capital build-up before Basel III happened at a time where the economy was also slowing down. In my opinion, looking forward, the good capital buffer some of these large banks have is a point for investor comfort. And I believe that's also one reason why when the valuations dropped to 30 to 40% of their book values, long-term investors, large investors stepped in and picked up those stakes. Those are my initial thoughts, Mr.
Thank you. Ruchir, Ruchir, I just want to ask what kind of what is your situation? Can people hear me?
You're cracking up
Yes,
a
we
bit.
can.
Okay. Charita, you take over in case I drop. Just want to check. Ruchir, what has been your experience in terms of, have you sold or have you bought more in the last post-COVID opening? What has been the kind of sentiments expressed to some of your peers?
Right. So from a foreign investor perspective, I think what we've seen in the Colombo stock exchanges, we've seen foreigners sell after the market opened. Talking about us specifically, we have not sold because I think, like Chanaka mentioned, the valuations are too cheap. So I think it's too cheap to sell at this point in time, because if you take a longer term view, valuations are very attractive at this point in time. We've not increased, but we've not sold either, because some of these companies, some blue chip especially, are trading, like was mentioned earlier, at 2009 levels, which was just before the war ended or during the war. So valuations are just very attractive to make an exit from Sri Lanka at this point in time. Of course, to increase weight to Sri Lanka, there are a lot of factors at play. But the foreigners at this point in time, the other foreigners who may have sold their stocks in Sri Lanka, I don't think that's linked primarily because of Sri Lanka being a bad story or things going wrong because of the pandemic. I think it's more because of the general global market sentiment across emerging market funds and frontier market funds. The investors are pulling out. So when the fund has redemptions, they have to sell their stocks. So Sri Lanka, you saw more liquid stocks getting hit more. For example, John Keel's fell much more significantly because it's so liquid compared to, say, some of the banks, some of the less illiquid counters. So I would say it is more because of the global situation in emerging and frontier markets more than a Sri Lanka specific issue. And like I said, I think from a longer term perspective, there are issues which need to be overcome. So one is from a foreign investor perspective, the biggest, or some of the concerns are the debt levels. Debt to GDP is significantly high now. I think it will only increase post these government incentives that have been given. And one probably uncertainty investors face, especially this year and also previously, is the external repayments issue comes up every year. So that's why the Sri Lankan bonds also corrected a lot, because there was talks of default. Although I don't believe Sri Lanka is going to default, because the situation is quite stable from a foreign exchange perspective, reserve perspective, and also from the fact that you've got some foreign funding coming in from India and China, and also the IMF as well. So I don't think that's an issue. But of course, the steps the government is taking to reduce this, that is what the investors sometimes are not seeing. Of course, you had political instability from 2015 to 2018, beginning of 2019. Then you had a new government which came to power. It's only been a few months since they were in power in the pandemic. It didn't really get a chance to really execute a lot of these things. So if investors see that their execution on the reduction of debt levels, execution of policy making, that's very important. So for example, tax structure. The banks, until last year, the effective tax rate of banks was almost 60%. I mean, that is significantly high compared to any other market that anyone invests in. So, there was taxation on telecom towers, and they rolled it back to, they changed the rules on that. There's the tax structure on, for example, some consumer goods has been changing on a regular basis. So every year there's some change in the tax on the taxation structure. So that doesn't give comfort, I would say, to the investors in terms of which way, taxation structures and tax policy is going. And also on the infrastructure development part, yes, there have been a lot of improvements from the time I've been commissioning for the last 5 or 6 years. There have been improvements on that front. But again, you're doing 2 million tourists a year, which is significantly lower than most Asian tourist destinations, like even Cambodia or Vietnam. So the government has to probably bring in policies to improve tourism infrastructure, such as the airport development and the Central Expressway, which I believe is underway at this point in time. So there are, these are the issues which some of the concerns foreign investors have. They believe it's a good story. They know the valuations are cheap, but policy making sometimes doesn't get executed in the best possible way or in the most efficient way, which then keeps the valuation low. And that's what you've seen over the past, I would say, 5 years. Because until 2014, the P ratio was 14 times, and it's been basically below 10 times since then. Since 2015 onwards, since then. So yes, if post-pandemic, of course, you take a longer-term view of post-pandemic, if the current president and the government, which many people believe he has good execution capability, if that happens, I think the multiples will re-rate again, and you'll see more foreign investors coming to Sri Lanka.
Right, I think Nista has he's having some technical problem. So until he joins back, let me raise a question to all our panelists, right? Maybe Hasda, you can take it first. The question is, what are the risks that the investors should be aware under new normal environment when investing in the shares of public quoted companies?
Yeah, so I'll start with a couple of points. I think the first thing that comes to my mind immediately is that when we look at the 31st March quarter-ending financials that were released, which is what's really coming out as we speak in the market, most of them have not got any or very little impact due to on the current situation being reflected, because most part of the quarter was relatively pre-COVID. It was only about a week or two. Most companies did have an impact. So looking at that quarter results, if you're trying to make the future projections, I think they need to be very careful. So that's one thing, because ultimately the critical question, like what I said earlier, is that how bad this 1 year will be, 1 year earnings, next 12 months earnings will be. That's the first challenge that one will always go through in terms of forecasting. And the second implication that need to be looked at is what's the permanent, if there is a permanent damage, what is the extent of the permanent damage to the economy and to the companies that are listed in the market, and if so, whether there will be a long impact on the longer term fundamentals, and whether there is a rating that probably need to come down and kind of a re-rating to come for the market. So those are the two important things to look. So in that context, if you look at the risks there, first one, when the investors will have to be vigilant, analysts will have to be vigilant when the corporate results are being released in the next 2 to 3 quarters. Obviously, the June quarter numbers probably be a bloodbath. That's what I would think, because there wasn't too much of business at all during the month of April and most part of May. So except for very few companies, others will definitely have a significant drop in the earnings. So I think that has already got factored in the market conditions, in the prices. That's why we saw the sudden dip. And then if we see that the companies are giving the direction, and then directionally it's going to pick up on a positive note quarter on quarter in terms of the earnings, and the businesses have revived, they have come out with alternative business strategies, then you will see some sort of a upward momentum in the earnings in the next 4 quarters. And that's something that investors will have to closely look at it, because the risk there is that with 1 quarter earnings coming out, whether there should be another reaction, a negative reaction in the market, because there's nothing to be surprised about the 30th June quarter numbers being pretty bad, right? It's going to be pretty bad, there's no doubt about it, because it's not Sri Lanka, it's the whole world. But if the trend is positive, so getting that information, getting that directional input from the companies will be crucial, because once you get a feeler of that, then that really will answer the question in terms of whether it's on a positive trend and should we gradually start picking up those stocks. Because if there is a 1 year impact, and that impact is absorbed in the current price, then the current valuation reflects that, and then that will clearly indicate that that's a good time to buy, or because there's a potential for the price to go up. The second point that I mentioned, what is the permanent damage? Now, this is the serious part of it. So you have to look at industry-wide, in my opinion, and because some companies, some industries will have a lag effect. For example, if you take the banking sector immediate impact versus there might be also a lag effect, because there'll be the NPL situations that will gradually keep coming, and NPLs are likely to have a increase in the coming months, because the first half of the finance, at least from April to October, there wouldn't be too much of NPLs to talk about, because most have given kind of moratoriums and extended the credit periods for the corporate as well as the individual clients. So in that context, you would not see the real impact of the loan book in the first 6 months the way I see it. But if you look at some of the other businesses like retail businesses, maybe even the normally defensive stocks like healthcare industry, the hospitals, etc., also will see a sizable impact, because this is a unique case where people were scared to even walk into a hospital, and as a result, even a hospital's income will get impacted in this situation. So the bottom line is that to your specific question on what's the risk that you need to look at, is that you should be very careful in assessing the 12 months impact, and taking a view on the stock. And then, like what I said at the beginning, what is the longer term permanent damage, and obviously to that particular industry, so it's a 5 to 10% impact, or whether it's more, is something that you need to look at. And accordingly, that particular company in concern that you're looking at investing, we need to be looked at how resilient that company has been in the past, how strong the balance sheet is, so that it kind of gives them the headroom to operate for the longer term, taking punches from a cash flow perspective. And then how responsive have been the management team in the past to shocks, and how have they bounced back, and how they have responded in difficult times in the past. And then, of course, look at the industry-wide broader impact that comes in, and whether there is opportunity that the mergers of acquisitions and market share gains can be looked at, so that that particular company in concern that you're looking to invest, whether it can get up there more momentum, and probably have a better picture even under the post-COVID environment, so that there will be opportunities for the people to step in. So I think my first argument is about the corporate earnings, where how the 12 months and beyond need to be looked at, and then set up a valuation range and look at how to gradually build in. So the risk will be that in doing that, the information available will be a big challenge. I'm talking as a if I wear my corporate hat. Obviously, the forecasting right now is a challenging thing because nobody really knows yet as to how exactly the second or a third wave will behave. So there we have to be, while we say today it's better than 2 months ago, we can't be overly optimistic and say that, guess what, it's now back to normal, or, you know, things are going to be great, because tomorrow one screw up can really pull us back. So it has to be something that even the management who's trying to do a forecast is also playing it a bit in the dark. That has to be understood as an investor. So that's why you cannot just jump in, you know, blindly and say that, wow, the valuations are great, let's go and buy. You know, I would not take that view, but I'd rather take the view that you have to look at the 12 months for the next 4 quarters and as one bucket, and then look at the beyond that period, maybe 12 to 18 month period as another bucket, and look at trying to establish some form of a forecast in where things are going. And I'm sure the market analysts are doing a lot of work in that context to get there. But who's getting closer in terms of the valuations is something that you need to look at. So it has to be stock picking. It can't be that the general market is great and therefore we will go in. I would have done that when the stocks fell to that intraday low, right? I would have picked something, but since then things have picked up. So now you will have to get into a mode of stock picking, because some companies have obviously, some prices have obviously come up since then, and then you need to look at your horizon and take a very calculated risk in terms of how you are entering under very difficult circumstances in the economic and the global environment.
Yeah. Sorry, I missed out of one technology. Just want to know this. I know there is valuations are excellent right now. There is this debate as to who should come into the market. The captive funds have been rather dormant in the last few. Though they have been promised. Then there is expectation that foreigners must lead the run, or should be local. I'd like the panel to sort of shed some insights. We are all Sri Lankans. We need to bet on our own economy. Why are we waiting till foreigners come and, guide us?
Yeah, so Nisa, in my opinion, I think we should. No individual can tell an investor, professional investor, what he or she should be doing or not doing. At the end of the day, how things work out is in a sequence. So, what is the right sequence for confidence moving in the positive direction? In my opinion, there are a couple of time frames for that. In the nearest term, people would see to what extent the economic activity recovers to the pre-lockdown norm. So some of the things that we have seen is that ride-sharing companies are saying their volumes are up to about 40% of the pre-lockdown. We saw the power generation statistics that recently came out from the bottom of the curfew. The power generation is now up about 12% from the down. Also, it's very important to see how Sri Lanka's relative success in managing the COVID scenario, with only, let's say, 10 deaths, perhaps 1,000 to 10,000 times less than some of the larger economies, is getting translated to economic success. So I think it's very heartening to see that Sri Lanka's tourism authorities and the industry coming up with plans to be one of the first locations in the region to open up. The dates that are spoken about are for small groups as early as end of this month, subject to PCR testing protocols, pre-onboarding and immediately upon landing. For more larger groups, the last month of the summer travel, the month of August, there are plans being discussed about. But even in a worst case, we can see situations, unless you believe that there is going to be a major second wave or there are facts to support that kind of a belief, we will see that some of our sectors like tourism coming into some mode of activity for the winter season. So all those things would be a domestic confidence building measures. From an outside perspective, it's very, very, very important for Sri Lanka to continue demonstrate commitment to our international sovereign bond holders. I think that confidence we demonstrate, already the markets have reacted very well for the central bank's announcement of commitment to our bondholders. We have seen some of the sovereign bonds, the benchmark sovereign bonds, what is due immediately this year, as well as the 2030 bond rallying 10 to 15%, of course, in very low volume. Yeah.
Chanakya, no, I'll come to the bonds, but I'm just asking this question. We have this debate: should the captive funds come and be a trendsetter? Because Asita was talking about 12 to 18 months horizon outlook. If so, the EPFs and the ETFs and the insurance must come and demonstrate that they have the confidence before the local investors. I mean, we are still talking about this. How should Sri Lanka pursue post-COVID in terms of some of these funds coming into the market?
Well, I mean, like the way I see it is that these funds also need to evaluate the interest rate environment. During the last 20 years, these funds actually demonstrated quite good returns, but they demonstrated it in an environment where our inflation and our interest rates were structurally higher. So a post-COVID environment, if other things work out and if we move into the normal interest rates that you see in other countries in the region, unless you have at least a minimal exposure to the equity markets, you can't maintain the returns to your pension holders and your long-term investors. I mean, we see some of these captive funds having equity exposure less than 3 to 4% of their total portfolios. So I feel that if they believe that the interest rates are going to be structurally low, they need to also evaluate having a higher portfolio exposures, and perhaps these valuations that you see right now are basically an opportunity from that perspective. That's my personal view, Nista.
Asita, any insights on that? You'd have heard this debate going on for years.
Yeah, so I think the background of some of the local state funds in the last 3-4 years have been that they've been fairly careful and taken account, and you can't blame them because of the circumstances as well. But having said that, I fully agree that there is a definite opportunity for long-term funds to come, because one thing there in the country, we are here and we have to make the country. So obviously foreigners can go and invest anywhere they want, but these funds probably will look at investment opportunities within. So in that context, they can take more of a longer term view, and also within the opportunities that you're talking about. And given that the interest rates are pretty low and it will kind of remain low for some time, the deploying in the short term, even with a little bit of the risk levels being looked at, I think it's important that there has to be some level of involvement of the foreign funds, not politically directed. That has to be said, right? It should not be politically directed, because that's when the real uncertainty and sort of the issues start coming in. It has to be because the valuations are good and it's for the long term, and prices 1 year ago, or maybe in the last pre-COVID prices, when you look at and where the opportunities are, that individual stock picking has to start, in my opinion, and definitely the long-term pension funds have to take a lead, because long-term fundamentals have not changed too much in the current context.
Fine, right. Ruchir, do you like, as a foreign investor, do you like to see more active local participation, particularly from institutional investors? I mean, what's your perspective?
Right. I think if you look at, in general, smaller emerging markets and frontier markets, there is a very active domestic investor base. It's not led just by foreigners, or the local investors are not depending on foreigners to drive sentiment or drive investment, etc. So I mean, if you look at markets like, say, Pakistan, it's very domestic heavy. It's done very well, especially in the last pre-pandemic. It did quite well from the second half of 2019, despite foreigners being net sellers, because domestic investors came in. They saw the opportunity. Even this year, post March, the low of March 31st, after all the global markets side, Pakistan was the second best, in fact, the best performing market in April 2020. This is all driven by locals, not foreigners at all. Bangladesh as well. In Bangladesh, I think only foreigners account for just 5 or 6% of total daily turnover, so it's more domestic driven. Vietnam as well so far this year. Vietnam's market is only down 10% year to date in dollar terms. This, other markets like Indonesia, India down between almost 30%. But foreigners have been net sellers in this year in Vietnam, despite the story being so good, in terms of benefit from the trade war and valuations, etc., and doing well in the pandemic. It's basically local investors who come in. So I think if you have a larger local investor base, a more active local investor base, which is more proactive and drive sentiment, that will be very helpful for the overall market. So I think if you look at some of the other markets, even India for that matter, foreigners drive the market, but also a lot of local funds, especially last time. GDP growth, even before the pandemic, was 3%, 4%. There's not much. But the market was going up because of the local mutual funds, the local liquidity, not because of foreigners were net sellers. So I think if you build that local market, the domestic sentiment, or the domestic investor base, I think that will be very helpful for the market in the long term as well, from market sentiment perspective.
Good. Just want to check. There are two overhangs facing the market. One is the debt repayment. I think Chanakya did start commenting on it, but I just held you back till we asked this question. I want from both the three panelists as to what your own take in terms of how confident are you that Sri Lanka will manage this huge debt mountain. One is there is really appeals going around for rescheduling or some kind of deferment or relief. What would be the impact? I mean, is that a big concern? How confident are you that Sri Lanka will resolve it? We have never defaulted in the past, despite 30 years of war. So that comfort zone is there, but still there is more concern right now. I'd like the panelists to sort of comment quickly on that particular aspect. Chanakya, I'll give you.
Yeah, so in the near term, I think Sri Lanka's progress in the debt restructuring and our very strong economic partnership with two critical countries, India and China, would mean everything in the near term. I think it would be both a determinant of how we come out of the COVID crisis, as well as how we create investor confidence, because these are our two largest investors. These two countries account for our largest tourist inbound markets, and they are also deeply invested in Sri Lanka for many reasons. So our ability to further strengthen that relationship and drive positive debt restructuring, and the outcomes from that will be a major investor confidence booster. But we shouldn't forget the importance of IMF as an institution for Sri Lanka. Yes, India and China are our biggest partners, but it's very important that we have a positive engagement with the IMF. And in my view, the completion of the election cycle would create the conducive environment for us to have a very positive and a confidence building engagement with the IMF also. That's my view.
Okay, thanks. Hasita, any insights? And I'll come to Ruchir after that.
Yeah, I think the short term, there should not be too much of an issue. I feel that this year requirements, servicing requirements, we should be able to meet. Obviously, the next 2 years will be challenging, but we have time in hand. And it was anyway challenging even pre-COVID, with the low tax regime being coming in and the volumes to be picked up, and obviously whether the economic activity will support that kind of growth was always a question for the next 2 to 3 years, because the next 2 years also we have a heavy outflow that need to be serviced. So I think the next 2 years, how the government plans out the cash flows will be very important. That's yet to be seen. But I feel that this year, which is the most critical part of the conversation, because with COVID, how do we kind of respond? So like Chanakya said, I think there will be bilateral discussions which will give China, India prominence, and also I believe that other organizations, the donor organizations, as well as the other institutions need to be spoken to. But my view is that this year there will be definitely a positive move, and there should not be any issue of servicing, because we have one thing, we have the reserves. The other thing is that there are certain arrangements that have been worked out, as we can see in the media, etc. So that will go through. But the next 2 years is the real challenge, and for that, having a sustainable model will be key. And one thing that we need to note is that the continuity of the sovereign bond based refinancing model. Now that will really be challenged, especially with the rates, right? I think still you can go to the market, still you can raise, but the rates might look a little challenging in that context. But given that the global interest rates have come down, especially with the LIBOR, etc., I think there should be still an opportunity for us to keep doing that. Maybe not in the short term, but at least in the next couple of years. But for that to happen, we need to structurally reorganize our economic reforms and the economic platform, and give direction to the investors on where we are heading. And once you see the positive story, I think then obviously the chances for new bonds to come in the next 2 years will be coming in. So simple answer to you is this year I don't think some new bonds will go into the market, but you need to find alternate ways, which I think government have a fairly a decent hang of it, and we'll get through this year. And the next year you need to get back to the sovereign bond market on one side. For that to happen, you need to get your economic story clear and the policy framework clear, and also in the meantime look at other alternative channels to drive investment through special investment. I think that has been mentioned very clearly, that it has to be investment driven more than debt driven.
Ruchir?
Yeah, I think so. The the sovereign bond repayment is not an issue at all. I think it was completely overdone in the last couple of months post-pandemic, when there was panic that Sri Lanka default. Sri Lanka's never defaulted, like you mentioned. We had this issue last year as well in terms of, or in 2018, if I'm not mistaken, in terms of repayments, but it was sorted out eventually. And for this year, I think it's fine. No, I mean, foreign exchange positions, reserve position is fine. Covers, I think, 4 to 5 months of imports. You have the funding coming from India and IMF, and potentially from India and China, and potentially IMF as well post the elections. So I don't see funding as an issue for this year. Longer term, I mean, look, this issue is going to keep coming up every 18 months or 12 months, depending on how the funding situation looks and how the global liquid situation looks. But longer term, I think there are two important policies which the government needs to get it right and execute efficiently and soon. So two important industries is tourism and trade. I mean, tourism, like I mentioned earlier, you were doing 2 million tourists before the Easter Sunday attacks. I mean, 2 million is a very small number compared to other Asian markets. You can clearly do much more. You can do 5-6 million over the next 5-6 years, assuming the policies are put in place, and also infrastructure, in expanding the airport, putting those policies in place. And two is trade. I mean, the geographic location of Sri Lanka, I mean, it's second to none. Sri Lanka as a country, Colombo port itself handles 8 million containers a year, which is almost what all of India handles. So, I mean, your location is such advantages. You should take full advantage of that, given the fact that you are, in that important sea lane. You have good relations with most almost all South Asian countries. Good relations with China as well. Same for Singapore. So I think you should clearly take advantage of that, because how do you reduce this issue of investors having some uncertainty that Asia is going to repay next year, will have issues repaying next year? Is building a foreign exchange position, and that's going to come through trade and tourism. I mean, those are two low-hanging fruits for Sri Lanka. They should take complete advantage of that and put in the policies in place and focus just on that. I mean, there was talk earlier of manufacturing. Yes, you can do a bit of manufacturing, but at the end of the day, you're 20 million people. I mean, it's not Vietnam is 100 million people, or Bangladesh with 165 million people. So you have to play at your advantages. Your advantages are tourism and trade, in my opinion. The government should definitely focus on that over the next 5 years, and this will really significantly help you build up your foreign exchange position. And so this uncertainty of foreign repayments will eventually then die down over a period of time.
Fine. There was a question earlier from the participants. Despite this, I mean, the panel looks very optimistic, both in terms of debt situation, and maybe we didn't tackle the fiscal space and the fiscal challenges of the government. The rating agencies have downgraded Sri Lanka. I mean, I don't want to go on a critical or go to critique that too much, but do you think that was it warranted, or was it sort of a overreaction to the situation, like Ruchir said, or you think they will sort of, despite the rating downgrades, Sri Lanka's medium-term outlook remains okay in terms of debt and fiscal? Chanakya and
Nisa, I mean, at the end of the day, I mean, I mean, those views are very fair because no one can deny Sri Lanka's short to medium term economic challenges. Yes, we have one of the highest debt to GDP burdens. We have very high debt repayments as a percentage of our government revenues. Plus, we are basically undergoing two major events just within a period of 11 months. And for a small economy like that, highly dependent on few industries, I mean, that's a massive hit. So I think those views are fair. I think what is really important, at least for the domestic investors who have been in these markets for a longer term, is also to develop a slightly evened out perspective. Let's not forget that we are, between 2002 and 2005, Sri Lanka's debt to GDP on a couple of years actually exceeded 100%. We also fought a very, very, very intense civil war, ended it, and we also saw the debt to GDP levels coming down from that 100% level to 74, 73% levels over a decade, along with a very decent growth profile being maintained by the economy. And that is what is basically created the economic confidence in Sri Lanka, as reflected in our ability to access international sovereign bond markets and things like that. So I think what is really important is that, yes, it's a risky situation, but doing the right things in a progressive way and having the political stability in order to drive those measures. To me, political stability is not an ideological thing. To me, it is about spending political capital on some of the tough decisions that you need to make in order to make the economy competitive, and even showing the commitment to international sovereign bond holders requires political stability, because you won't have two parts of the government saying, no, we should not pay the sovereign bond holders. You see no strong statements coming in. Yes, we are not going to let you down. We are going to meet all our commitments, and this is our plan to do so. I mean, that's my view on that, Mr.
Okay, thanks for bringing the political stability aspect. I'm sure the rest of the panelists also will have their own opinion about political need for political stability. We are heading for elections, hopefully. How critical is this? I mean, this is a apolitical statement from an investor perspective. How critical is this political stability, particularly elections? There is a debate whether we should have it or not. Ruchir and Hasita, I mean, from a market perspective.
Yeah, I mean, I think political stability is very critical, especially from a Sri Lanka context at this point in time, because you had first the Easter Sunday attack, which impacted the economy. Then you had the COVID pandemic issue, which is affecting the economy as well. So to bring back investor confidence domestically, also from foreign investors, I think you need the political stability. Because, I mean, like I mentioned earlier at the start of the call, your P ratio for the Colombo index was 14 times in 2014. And ever since then, it's gone to single digits. So how do you, I mean, the issue is not with the companies or the management teams. I mean, they're very well-run companies in Sri Lanka. There's no issue. They were around 10, 15 years ago. They're going to be around for the next 2 decades also. So they have not much leverage, strong brands, strong management teams. So the issue is not at the company bottom-up level. The issue is top-down. The top-down is the part, especially, and even the fiscal deficit issue, the foreign bond issue has been known for quite some time. It's not come up in the last 12 months. Those issues were there before even the political instability hit to some extent. So I would say political stability is the most critical factor to bring in the investor confidence, because that will help your policy making get on track and execute the policy making, which is very important to bring in the foreign exchange reserves and stabilize the economy. So I would say it is the most important factor from a foreign investor perspective.
Okay, Hasita, yeah.
I think we are coming out of a government change. Obviously, with the presidential election, we saw the government also changing. So naturally, when you had almost a 5-year tenure of a particular party and a government, and then you're changing to a new government, it has to be clear what the economic policy is, because you're at least talking about a 5-year view, which is important from an investment perspective. So for that to happen, on one side, I think the presidential election did give certain mandate of the current president on where the economic policies will be, but what comes really handy would be also to have the general elections and then have the executive and the legislator both in a common view, which has been a challenge always in certain parts of the years years in the past. So for that to happen, I think nobody is talking about not having elections. I think everybody is talking about timing of the elections because of the health first factor. I think I still believe that health is first, no doubt about that. But I think getting things going as soon as possible also equally important. So it's really balancing the two sides and getting it rolling, and then have a sort of economic view for the next 5 years to see what's going to happen to the reforms, what's going to happen to the funding strategies that have been adopted, what's going to happen to the infrastructure strategies that's been adopted, so that will there be changes from the last 5 years to the next 5 years, and obviously if there are changes, then where is it heading? So that kind of directional policy angle will be important to come for the investors to take a more of a on the longer term fundamentals. So there is no doubt that political stability you didn't change the rating for a long time. And obviously, there were the investment grade AA rated countries like Iceland going bankrupt, right? So in that light, it's fair by them that they give the ratings. Obviously, the pandemic is global, and one can always argue that in this kind of situation, there is no doubt that the ratings, everybody will come down. And I think rating reductions are not only us, it's across the world. Industries have been going through, global companies, the corporates have been going through. So I see it as more of a parameter-driven rating that has been enacted in the current circumstances. So you can't really blame the rating agencies for what it is.
Okay. I just want to the check on this. IMF has downgraded Sri Lanka's growth for -3%. Outlook for 2021, it doesn't look so great. We are coming from a low growth regime in the last few years. Also, there is this tendency right now, or there's some noises about protectionism. Look inward. I mean, it's different to what is import substitution versus export development. How should, in this transitional period, how careful should we calibrate our economic policies in terms of some of these, given the foreign exchange challenges, given the other fiscal revenue challenges? How should, in the next 12 to 18 months, Sri Lanka sort of manage this transition in terms of trade policy and economic policy? Any thoughts from the panel?
Well, Nista, I think as investors, we need to tune out a lot of the political noise globally, because I think some of the largest economies in the world are having certain trade conflicts. There is also a major election cycle happening in US. So you see quite a bit of news flow from a very partisan political and a very protectionist perspective. So I think as investors, we need to tune out also what is meant for the election cycle versus what are the longer term measures. For Sri Lanka particularly, I completely agree with Ruchi, 100%. We are historically a trade hub. Yes, we do have an agrarian base. We have 1/4 of our labor force in agriculture, but our economic future had been as a trading hub, as having one of the best ports in South Asia, catering to the Indian subcontinent, attracting investments both from India and China for our port assets, and in areas like tourism, in specialized exports like our apparel export industry that built up a very sophisticated business model with some of the best brands, and of course in the emerging services exports industry. So I believe that it's good to talk about protectionism, let's say from a food security perspective, but Sri Lanka's economic growth trajectory has very little to do with agriculture, and it has everything to do with tourism, everything to do with being a very competitive ports hub, everything to do with having sophisticated exports, including services exports.
Okay, thank you. Just I'd like the panel to take on the reforms challenge I mean, we have been talking a lot about much needed reforms. IMF has failed to some extent in getting Sri Lanka, partly because of political situation, to ensure Sri Lanka sticks to a very credible path of reforms, structural reforms and long-standing reforms, including privatization, which I think this government has said no way. Post-COVID, a lot of people think that there is a great opportunity to, come back with reforms. I mean, one is how politically strong is this regime to sort of undertake key reforms. I'm not talking about privatization, but that's a bonus. I want the panel to sort of reflect whether going forward, do you feel confident that a strong leader like Rajapaksa, Gotabaya Rajapaksa can deliver on the economic reforms front? Hasita and maybe Chanakya and then maybe Ruchi as well.
Yeah, I think the political will be critical here. As you said, there have been very clear direction on certain reforms, especially related to the state sector organizations, how it should be run. So there have been a different view to the privatization, where we need to run with maybe different type of management, different level of efficiencies, and deliver while being state-owned, but of course run like private companies, and increasing efficiencies and productivities of each of those areas. So that's not a very easy thing to execute, obviously, given the background, given the legacy that's there in each of these organizations. Change is not easy. So I think definitely there will be a push towards this change, especially after the elections are over. Right now, I think some of the unpopular decisions are held back, obviously because of elections. But I think down the road, with the elections being over, one can expect some traditionally held back decisions to be taken, and to push for the reforms. For the more than anything else, I think economically it's important that those reforms are being driven, and sometimes it might become inevitable that we do that, because we have seen very clearly in the past that we have come very close to certain closure of the loop, I would call it, right? But then it will go back to square one. So what's important would be that if there is the need, sometimes the crisis brings opportunity, and this is one of them, where we probably say that we have no choice. So some of the decisions that we take, even in companies, corporates today, is also not by choice, but you have to do. So you have to take some unpopular decisions. So sometimes with that, there might be a push to take some of those unpopular, difficult decisions, and the strong political leadership will be able to actually execute that. And I hope and pray that it will be towards the right path and the right direction, because some of these reforms are critical for us to move forward, especially in the current economic circumstances.
Any additional insights from the panel?
Yeah, well, I mean, I think, Nisa, each administration have different political mandates. I think the previous administration had a different mandate, more about constitutional reforms, etc. But I think this government got elected with a mandate for a more fast economic growth, infrastructure development, improving Sri Lanka's economic standpoint largely. So I feel that how the mandate will be maintained also is by driving those results. It's a chicken and egg situation. I feel that this administration has no choice than to demonstrate their economic capability by driving those hard decisions. And sometimes we all get confused with terminology. Yes, this privatization is a very political term, but I mean, let's also talk about partial listings of large financial sector assets the government has. You know, Sri Lankan government has at least 4 very large financial institutions that take up almost half the financial sector. So a partial listing of that could actually deepen the capital markets and benefit all Sri Lankans. So there are many things that you can calibrate, but we should also remember that we need to get the timing right. In the middle of economic firefight, you can't drive measures that would collapse demand conditions even further. So this is where our bilateral relationships with India and China and our relationship with IMF is very important. We need to buy time, and we need to time the fiscal reforms at the right moment. Otherwise, what you have is that we will get into a kind of a downward spiral because the demand conditions collapse, and it has a more than proportionate impact.
Okay, thank you. Charita, you can take some questions. Otherwise, I can continue if you because I think when I
Yes,
logged out, there were a lot of questions earlier on. So anything related to the panelists you can take. I will take it on from there.
Yes, I have a question to the panel. I would like to raise this question mainly from Chanakya. Now, the banking sector represents a significant portion of the stock market, and undoubtedly, yes, the banking sector is going to get affected with this post-COVID-19 impact. But with all the concessions that have been given, for example, the statutory reserve ratio have been reduced down to 4%, policy rates have been reduced, tax rates have been reduced, then certain financial taxes that were there have been taken out. With all that benefits, what sort of a cushioning out would happen? And mainly, can we justify the current price levels that we see, like about still they are like 20 to 30% low compared to what they were?
Yeah, so I mean, I look at the banking sector. Primarily, I look at the systematically important, very liquid blue chip commercial banks. So these banks have a decent profit cushion, were very well capitalized, mainly due to sustained capital additions that all these banks did from about 2016, 17, 18 onwards, because of the Basel III implementation. So I feel that the Sri Lanka systematically important banks have a sufficient cushion to go through near-term challenges. And that's why I feel one reason that drove investor confidence when the valuations dropped to between 30 to 40% of their book values. And the other thing is that we need to also remember that we have not had a licensed commercial bank, a systematically important commercial bank failing in Sri Lanka. In many emerging markets, it was not the case. And we have a very strong banking supervision team from the central bank over the past 3 decades have prevented any form of systematic instability in the domestic banking system. So all these things are comfort factors for the long-term investors. In the short term, yes, there would be a drop in their profitability, but is it unsustainable given the capital buffers that they have built? In my personal view, the answer is no. And that's why I personally think the valuations, when they hit about 30% of their book values, significantly sometimes lower than what we saw the average during the war years also. Some institutional investors thought that it is perhaps like a multi-decade buying opportunity.
Ruchir, would you also like to share your comments or add something to what Chanakya just explained?
Yeah, I mean, look, in terms of the banks, of course, they've had some issues, not just because of the pandemic, but they had the issues last year as well because of the moratoriums post Easter Sunday attacks, and they had the higher taxes before the tax structures were reduced by the new government, and now you have the pandemic-led moratoriums and issues with respect to NPS as well. But yes, I agree. If you take a longer-term view, if you're willing to not receive dividends this year, because banks, I don't think, can pay dividends this year. If you're willing to sacrifice that, and you take a longer-term view, then if you're getting, especially the top 3 private banks, getting at 0.4 and 0.5 times price to book, with capital adequacy ratios which are well above the requirements, then yes, the banks do make a longer-term investment case at this point in time. However, I think in the short run, not just Sri Lanka, I think banks across emerging markets, especially emerging and frontier markets, are facing this issue because of government intervention. Government saying, okay, you should give more moratorium, you should reduce interest rates further. You know, for example, Bangladesh is saying don't even record interest income for the next 2 months. Those talks are going on. So you could, I mean, depending on how the economic impact of the pandemic is not yet fully reflected in the numbers as yet. It'll only reflect in the April to June quarter and even beyond that. So the numbers don't look good. If SMEs and retail customers are still feeling the pain, the government could step in again and say, okay, listen, you have to extend the moratoriums by maybe 6 more months. Who knows? So that's a near-term concern, but long-term is well capitalized and very cheap. But the other thing I would like to add is in Sri Lanka and also some other markets, I think the stocks which will do well near-term, despite the hit to earnings, is the domestic consumption stories. So as consumers and businesses come out of the lockdown, they get back to some normalcy in terms of economic activity, you will see domestic stories recover first in terms of stock prices and also probably even earnings growth eventually, because these companies were relatively less impacted by, say, they're not focusing on tourism or not focusing on government exports, or they're not banks which have to write off sort of loans. So I would say domestic stories would come back first, and therefore you've seen some domestic companies in Sri Lanka, for example, Dialog has done quite well since the beginning of since the market reopened. So are some consumer staple companies. So I would focus from an investor perspective over the next shorter term, at least for this year, focus on more domestic stories rather than export or tourism. And the same as applies to the other markets we invest in. We've seen more domestic driven companies do much better from a stock price performance compared to like exporters or tourism companies and our banks. So I would focus on domestic stories over the next 3 or 6 months.
Good. I just want to, we are just approaching 1.5 hours of our time. Just want to know what kind of a regulatory environment is conducive from a capital market perspective. We haven't touched on the role of the regulator and as well as the stock exchange in terms of both parties in terms of improving listing, liquidity, disclosures, governance. I mean, in these times of crisis, it's always sometimes those tend to get ignored. What should be the way forward from a market development and robust capital market aspect? I'd like the panel to sort of share some insights into the best practice or way forward. Who would like to start?
Maybe I can pitch in for a minute or so. So I think from a disclosure perspective, there's no issue in Sri Lanka. I think companies disclose numbers on quarterly basis. All the filings are in English. From a foreign investor perspective, getting information on companies is not really an issue. So I don't think disclosure is an issue. I would say the near-term issue, like I mentioned at the start of the call, is the market was shut for 2 months. So the regulator should, I think, effectively communicate what their plans and policies are in terms of if this ever happens again, who knows what it would be, but how does the market keep functioning despite some of the issues? For example, after East Sunday attacks as well, the market was shut for 1 day on a Monday, if I'm not mistaken. So I think the regulator should really focus on some of these, some of these practices to come up with a solution as to how they can keep the market functioning, irrespective of what is happening globally, also in the country. And if they can communicate that to the investors, they can give. It's not just us, but also the other market investors who have invested in Sri Lanka, or some of the new ones who look at Sri Lanka potentially in the future, given the confidence that this would not happen again in terms of market being shut for 2 months, which is, I think, a big risk for any fund, because if a fund has to sell or has a redemption pressure from their clients and they can't sell a stock, then they're basically stuck, and then therefore they will take a big hit from their reputation perspective as well when they are facing from their clients. So I think that's very important. And look, from a liquidity perspective, most smaller emerging markets, frontier markets are not very liquid anyway. So Sri Lanka, it's not that Sri Lanka is not liquid and the other markets are very liquid. So, Sri Lanka, there are ways to improve it. I mean, maybe bring in some of the larger government companies which are large SOEs, make them list. Or I'm not aware of which are larger private companies in Sri Lanka, but if they can give incentives to list, for example, Bangladesh listed companies have to pay a lower effective corporate tax rate if they list. So if you can bring in some of those incentives, they can bring more listings into the market. And that's how you increase liquidity. But also some of the other existing listings which are listed, I think the regulator introduced a rule, but I don't know how effective it has been in terms of increasing liquidity. The free float should be, I think, 10 or 15%. I'm not sure what the number is, but it's not really led to a whole liquidity in some of the companies. The liquidity is still quite low. So if the regulator can come up with a solution or a policy increasing liquidity in existing companies as well, that will really help market sentiment also, because there's some very well-run companies which investors cannot buy at all, especially in the consumer space, which has basically no liquidity. So if that can happen, that can change, that will be very helpful.
Any local insights, or you think we have debated this?
Just one point I would like to add, going slightly beyond the normal the market regulation, but more to the broader regulatory framework. I think one thing that also need to be looked at, Nista, in this type of environment, especially coming out of a pandemic and difficult economic conditions, is that the mergers and acquisitions, right? We have from a banking perspective, we spoke about the challenges and the positive side of things, but one of the challenges that all banking system will go through is the high non-performing loan percentages that can come in the next 6 to 12 months. So in that backdrop, there has to be certain restructuring, certain ownership structuring, because depending on what exactly the issue is, whether it's a balance sheet issue or whether it's a market issue or whether it's a business issue, whether banks, either investment banks or similar bodies, can get together and look at certain restructuring programs supported by the broader regulatory framework to ensure that there will be a complete kind of a recovery at that in the 12 to 18 months. Obviously, in the next 12 months, there won't be a complete recovery for sure. There's no doubt about it. But then at least in the 12 to 18 months, can we get to that? And if so, certain industry consolidations might have to happen. Certain support regulatory framework has to support to bring those restructuring in a more organized manner. Because if a certain part of the SME sector gets impacted through the situation, and if it goes out of the picture, that will become a big issue. So I think it will be important that that angle is being looked at by regulatory bodies. I won't necessarily say market regulator, but I'm talking about in general the broader regulatory body, so that there will be a stronger view on how we can restructure organizations, companies, SMEs to ensure that they are back on track in the next 12 to 18 months when things settle down.
I think I'd just like to move on to some of the questions from the audience. I think some questions, I think, Hasita, you answered that there'll be opportunities for mergers and acquisitions post-COVID in the market that was announced. There is some question to, so what's your view on Chanakya control economy policies? I think you did respond to it about import restrictions. Then this about, is government justified in instructing banks not to pay dividends? Any comments from the panel? I'm sure, I think that was also referred to it.
Yeah, I think
dividends going forward.
Most of the regulators, Nista, wanted the banks to keep the accumulated profit as the capital buffer as the entire goes through a pandemic. So I think it was done in many other markets, and it was certainly a very forward-looking measure by Sri Lanka's banking regulator. I think for long-term investors, it should be a confidence factor that banks have the balance sheet to sustain certain near-term difficulties.
Okay, fine. Charita, I'll give you an opportunity to ask any questions from earlier based on one before we wrap it up.
From the attendees, there's one question. I think this is one of the most famous questions. Bit of open-ended question. What would be the most potentially attractive industries to invest looking in the next 2 to 3 year horizon? So this is something which everyone is interested about. So if you all can share some light on that.
So maybe I can start off. So I would say in Sri Lanka, the consumer sector looks quite attractive because one, the penetration levels are still quite low in terms of consumer goods, some of the consumer staples as well. The companies are well managed, have good cash flows, and not very leveraged, and also the valuations are quite attractive. So I would focus on some of the consumer names out there in the market, which will be better bets, especially the way the situation or the scenario we are at this point in time. So I would focus on those names over the next 2 years at this point in time.
Hasita, would you like to answer that question?
Yeah, so like what I said earlier, I think I still think the banking side still there will be opportunities to look at, especially with the potential industry consolidation opportunities that may come, and a lot of non-banking financial institutions are also having a lot of challenges. So there are some level of consolidation in those areas is something that I see happening, because if you don't do that, there will be a lot of other challenges, especially with the capital adequacy requirements that were anyway on the cards pre-COVID, and plus what's going on here will create a need for that to happen. Also, I think one other way of looking at the whole equation is that some of the worst hit industries, right, like tourism, like construction, like real estate, like import, right? If you take those industries and look at the valuations today, the prices, how much has it dropped? It has kind of gone completely off track, and prices have crashed significantly. And then look at those industries and those companies specifically, and look at what the management, the ability, like what I mentioned earlier, the ability to rebound, the strength of the balance sheet to weather the storm. And based on that, start looking at some of the worst hit industries, best possible companies available at a low price. So that's another angle I would look at it, because everybody will start chasing probably the less impacted industries. But certainly when you look at the worst hit industries, you should not forget that industry, because some of those industries are catalysts of the countries. Like when you talk about the tourism will bounce back for sure. It's not going to be indoor tourism for rest of our lives, right? So that's definitely going to be there. As a logistics hub, we will definitely going to be stronger. So some of the worst hit industries, best possible companies based on some of those criteria, and look at taking a bet on some of those if the valuations look attractive.
Yeah, I think.
Thank you, Haritha. Yeah, Nista, go ahead.
Anaki, you have any picks?
No, Nista, I think I agree.
Chanakya, do you have any industry picks as to?
No, Nisa, I mean,
Okay,
I have
fine.
nothing more to add to what Ruchira and Hasita said. Only thing that I want to add is that over the next 3 months, things would be clearer as we see economic activity and certain sector-specific conditions picking up. So you will see opportunities over the next 3 months, depending on how the economy progresses and to what extent the activity levels come back to the pre-curfew norms.
Okay, right. There are a lot of questions about asking this panel to bet on a ASPI level at end of the year. I don't think we are giving that kind of service through this webinar, but I like to ask the panel, what would be your closing remarks in terms of, I know there was a lot of insight shared in terms of the valuations and attractiveness of the market. For an investor, what would be your advice in the next 6 to 12 months horizon? What would be your maybe 1 or 2, 3 key advices you want to share with investors? I want all the 3 panelists to comment on it before we wrap it up. Ruchir, maybe I'll start with you.
Sure. So, I mean, look, from an investor perspective, you should be prepared to face some bad numbers and bad news because of the economy, especially in the next 6 to 9 months. So don't expect things to pick up. For example, if you're doing 3 or 4% GDP growth, that's not going to happen in the next quarter or 2 quarters, maybe after, not even after 3 quarters. So over here, at this point in time, you really have to take a longer term view. If you're playing for the next 6 or 9 months, in terms of trying to find which particular sectors will do well, I think, like I mentioned earlier, I think domestic storage will do much better initially because they've been less impacted by the whole pandemic. And as economic recovery restarts after the curfew and after the lockdown, some of these companies in the telecom space, consumer staple space, will do relatively better than some of the other companies. Longer term, I think from a country perspective, I think tourism and trade are the 2 key areas that the government should focus on. That will bring in the foreign exchange reserves, that will bring in also GDP growth for the country as well. And also the consumer sector will still stand out for Sri Lanka because the penetration level is still low. And one thing I mentioned earlier was, I think modern retail is a big growth opportunity in Sri Lanka. So I mean, in terms of modern retail malls, in terms of grocery, modern retail, there is a big opportunity for Sri Lanka. And as the tourism sector grows, as the service industry grows, you'll see modern retail develop as well, as you've seen in other markets in Asia, like Hong Kong, Singapore, Thailand, and also Malaysia. So I think focus on tourism and trade in the long term as a policy perspective, and short term you can focus on the domestic themes, which should do relatively better than some of the other stocks.
Thanks. Okay, Hasita.
Yeah. So if I summarize, Nista, I think what I said earlier, actually, first thing I want to bring as a closing remark is that things are not going to be rosy in the short term, right? When I say short term, probably it can extend beyond 6 to 12 months to about 6 to 12 month horizon, especially the 30th June numbers when they come in. Don't close the market again with a 10% drop in the morning, right? Because there is no surprise there. The results will be bad. Right, no doubt about it, and be ready for it and absorb it. And obviously the prices have reflected that. So first message is don't panic and react. right? That's the first thing, because you will burn your fingers, especially as a retail investor, because there'll be bargain hunters who are waiting to pick your stock at a very low price, right? That's number one, right? Number two, like what I've been talking through the session, that don't go on a market-wide investment mode, but you should look at it more on stock picking, on a bottom-up approach, which we call it in investment language, where essentially look for companies who are going to win post-COVID in industries, even whether it's a good or a bad or a most impacted industry, doesn't matter, right? And look at it in the context of the good balance sheets, the good management teams that come through, and also look at it in the context of how their past track record in terms of being resilient in difficult times and bouncing back, right? So that's the second message, and start looking at more of a bottom-up approach. Third advice I would put is that obviously this is a global problem. This is not a local problem. So there will be challenges for the country, the economy at large. So we have to go through that in the next 12 to 18 months. So when you make an investment, ideally look at the investment as a 12 to maybe 18 to 18 months beyond type of investment. Because today, if you go and put your money in a bank deposit, you probably get about 7 to 8% or a little more than that kind of money. But if you're looking at it in an investment in the stock market for the medium to long term, I think the average returns can exceed 15%. Again, don't expect 100% increase from the market. Then you go to a casino and make that investment. Not here. Casinos are unfortunately closed, but when you open, you can try to do that. But in the market, if you're investing, ever modest, if you're 7% here, we're talking about 15 to 20% type of expectation in the next 3 years, and then look at average opportunity to accumulate and gradually build up a portfolio. Don't jump just overnight tomorrow morning, but gradually build up, because of the volatility, because of the uncertainty, market will be volatile. There'll be ups and downs, and in those downs, you should try to enter and pick fundamentally sound stocks, which can give you that 15 to 20% type of return in the next 3-year average.
Thank you. Excellent wrap up. Chanakya, final words.
Yeah, last thing I want to add is, Nista, over the next 6 months, as investors, we need to be able to filter the news flows, because we are going to get overwhelmed with quite a bit of high frequency news. US is going to an election. There is a trade war peaking between US and China, and most of the COVID related developments are also presented globally in a particular political perspective. I think as investors, we need to develop our personal worst case scenarios that we expect, and we need to continuously iterate our viewpoints to what is materially important in the news versus what is not really affecting our viewpoints. It is also very important to be liquid in the middle of a global crisis. If you are investors, I think liquidity is the key. Cash is king. You should not get into positions that you can't sustain over a 2 to 3 year period, even in a worst case scenario.
Thank you. Excellent. So the synopsis is that stay positive in the long run. I mean, though the news might be gloomy and the results might look very scary going forward, but I think there's a lot of value, as Charita explained. Excellent presentation as to what the market holds going forward. It's time to sort of pick up the opportunities on fundamentals, as well as your own assessment of, as Chanakya said, your own assessment of risk. And I think we also got a global investor perspective from Ruchir Desai in terms of what their outlook is going forward. So I'd like to thank Ruchir, who is the manager at Asia Frontier Capital Fund, for finding time from Hong Kong to be with us and our webinar participants. And also sharing fairly insightful thoughts in terms of way forward. I'd like to thank Hasita, as usual, for the group's CFO from the Group Finance Director from Randix, for being very frank, and Senior Director of Acuity Knowledge Partners in Sri Lanka for all of you, for in terms of insights. Thank you very much for your time and comments, and Charita as well on behalf of SC Securities. We will have hopefully have another, depending on how the market behaves going forward. we will might consider another webinar going forward, and will keep you posted. So thank you very much for webinar participants as well for making it interactive, and we'll see you soon on behalf of Daily FT and SC Securities. Thank you very much.
Thank you, everybody.
Right.
All the
Thank
best.
you, everyone.
All the best.